In our last class, we dissected the concept of weighted average cost of capital, and we said that weighted average cost of capital represents the overall cost of capital or required rate of return for a firm, and it is the average cost of a company's source of finance weighted according to the proportion of each source of funds in a company's total pool of capital. And we said that market value or book value can be used to estimate weighted average cost of capital. Okay? And that at all time, you have to use the market value. Why? Because market value is more realistic and acceptable by investors because it is the price determined by the market forces of demand and supply. And that's why market value reflects the current market condition. And that's why it is more preferable to the book value. Okay? And I gave you the formula that you can use to estimate the weighted average cost of capital. Okay? And of course, that's where we stopped last time. Today, we are purely going to be doing calculations. Okay? So if I'm able to solve like 3 different scenarios, that will be fine. If we still have time, I can then introduce you to project-specific cost of capital. If not, that's what we are going to do in our next class by the grace of God. So without wasting more time, now, what you should understand is that, like we have started, today is going to be our 4th lecture day, all right? So we started with uh, introduction to cost of capital. We started with the introduction to cost of capital, under which we talk about the importance of cost of capital, then how to estimate weighted average cost of capital using the traditional method, that is calculating traditional WACC, under which we discussed and demonstrated how to estimate cost of equity, cost of preference share, cost of debt. We also talked about cost of convertible securities. And before last week, when we now discussed the weighted average cost of capital. So there is no way you can just move ahead to estimate weighted average cost of capital without understanding how you are going to calculate the cost of individual source of finance. And that's why we have demonstrated how to calculate cost of equity, cost of preference share, and then cost of debt. You will recall that when we started on our first lecture day, I made it very clear to you that anytime you want to estimate WACC, you want to estimate traditional WACC, that there are 4 procedures that you are going to carry out. All of those procedures we have discussed there. And the last one, which of course is the weighted average cost of capital, we've also discussed how to estimate it. But today, we're only going to be doing calculations. Now, in addition to this, in calculating the weighted average cost of capital, like I said, if possible, if it is my plan today that we'll be able to complete it so that there's nothing like carryover. In fact, without wasting more time, let me start with this. Let me start with illustration number 13. We are going to solve this illustration number 13. Then I think last week or thereabouts, I also reshared a question I shared with you some minutes ago. So we are going to solve that question as well. Then we're also going to solve, there's one particular question. Yes, we're also going to solve this one too. Okay, so those are the 3 different questions that we are going to solve uh, today. Hopefully, we'll be able to complete it. So let's start with illustration number 10. Sorry, illustration number 13. Let me read the question. Okay. Please open to the material is on page 31. Page 31, illustration number 13. Yeah. The following figures have been extracted from the most recent account of Equity PLC balance sheet as at 30th June 2015. Ordinary share capital authorized 4 million shares of 1 naira. Summary of profits and dividends. So, this particular information has shown us that we are going to, because we are given information about capital structure, we have ordinary share capital, we also have a debenture. Okay, that's capital structure information. The current, that is 1st of July 2015, market value of Equity PLC ordinary shares is 3 naira 27 kobo per share cum div. All right. So we are given information about market price, share price. An annual dividend of 810,000 naira is due for payment shortly. Okay. We're also given dividend of the current dividend of 810,000 naira, and we are told that it's due for payment shortly. This is tautology because the market price given to us of 3 naira 27 kobo, examiner has already told us that it is cum div. When you now come here and be telling me that dividend is due for payment, that's you are repeating the same thing. All right. But in any case, it's exam question. Let's move on. The debentures are redeemable at par in 10 years' time. Okay, so we can confirm this is a redeemable debenture. Why? Because we are given the redemption date to be 10 years' time. So in this case, we are going to calculate our internal rate of return. Their current market value is 77 naira 10%. Forget about the 10%. It's 77 naira 10 kobo. All right. Annual interest has just been paid on the debentures. There are no issues or redemption of ordinary shares or debenture during the past 5 years. Okay. The current rate of corporation tax is 30%. Required. Calculate the cost of capital which Equity PLC should use as a discount rate when appraising new investment opportunities. Discuss any difficulties and uncertainties in your estimates. So we are required to calculate cost of capital. What kind of cost of capital do you want to calculate? Of course, this has to be traditional weighted average cost of capital. Why? Because we are given information about capital structure. We have ordinary share capital. We have a 7% debenture. We're also given dividend and then share price. We are given dividend and the interest. So which means that we are going to calculate traditional WACC. Now, when you look at the capital structure as given to us, we don't have preference shares. We only have ordinary share capital and then debenture. So which means we are going to carry out 3 steps to calculate our weighted average cost of capital. Step 1 is to calculate cost of equity. Step 2, cost of redeemable debenture. Then step 3, weighted average cost of capital. That's all you need to do. All right. So without wasting more time, let's begin to solve the question. I will stop sharing this and move to the working notes. Okay. Solution to illustration 13. Then that's page 30, what? 30, page 31. The name of the company is Equity PLC. We're asked to calculate cost of capital that will be suitable for Equity PLC to appraise its investment opportunities. So, and then we have identified from the question that we are going to calculate traditional weighted average cost of capital. So to do this, we are going to carry out 3 steps. Step 1 is to calculate cost of equity. denoted as KE. Now, before you put down your formula, you must ask yourself from the question, you probe the question, how are you going to estimate your cost of equity? Are you using dividend valuation model, capital asset pricing model, or Miller and Modigliani? Of course, in the question, we are given information about dividend and then share price, which means that we are going to calculate cost of equity using the dividend valuation model. Now, again, before you put down your formula, you have to ask the question, if there is growth, you want to know whether there's growth in dividend payments. Okay, you need to go back to the question and check whether there's growth, whether you are given growth rate. If you are not given growth rate, then there should be information on how you are going to estimate your growth rate. If there is no information about how to estimate growth rate, that means there is no growth in dividend payment. Okay, so let's go back to the question and check whether we are given information about dividend. Yes, when you look at the summary of profit and dividends, you will see second to the last line item in the table, you are given information about dividend between 2011 and 2015. You will notice that in 2011, we have dividend of 620,000 naira. In 2015, dividend has increased to 810,000 naira. That means there's growth in dividend payment. So in this case, we need to go and estimate the growth rate. All right. So first thing first, let's go back to our calculation. Now we have identified that dividend has grown from 620,000 naira in 2011 to 810,000 naira in 2015. Therefore, our cost of equity will be calculated as current dividend. Now, depending on the information, depending on the method that you want to use, if you like, you can use par value. If you like, you can use absolute value. Whichever one you use, you are going to get the same answer. What do I mean by absolute value and then par value? When you look at the dividend given to us, the dividend is absolute value, 810,000 naira. But the share price is par value, 3 naira 27 kobo. So it's par value. So whichever one you want to do, you have to decide from the beginning whether you want to use total value or you want to use par value. So like I said, anyone you use, you are still certainly going to get the same answer, but one is faster than the other. So let's use the par value quickly. So current dividend multiplied by, to calculate growth, to calculate cost of equity is current dividend multiplied by 1 plus the growth rate over x dividend share price plus the growth rate. All of this multiplied by 100 over 1. So this is the formula we are going to use to calculate our cost of equity. So DO is the current dividend, and we are given current dividend of 810,000. So let's convert it to dividend per share. We want to use par value. So the first page, second page, the first page should be sufficient for both of them. Then the second page, third page will be for our workings. Working number 1, we want to calculate dividend per share. Dividend per share is calculated as total dividend over a number of ordinary shares. Total dividend in 2015 is 810,000 naira. We then go back to the question, what's number of ordinary shares? Go to the balance sheets. According to the question, we are told that we are given ordinary share capital authorized 4 million shares. You don't use authorized. The total number of shares that the company can issue out is 4 million of 1 naira each. But that is not what you are going to use. So far, this company has issued 3 million shares. So it is the issue share capital that you are going to use. You don't use authorized shares. So 3 million shares is what we are going to use for our calculation. So I will then come in over 3 million shares. So this is equal to, from the calculator, let me see, 810 over 3,000. That's 27 kobo. Dividend per share is 27 kobo. Again, in the question, let's do some of the workings that we are going to need. In the question, we have identified that there's growth in dividend payments because between 2011 and 2015, dividend has grown from 620,000 to 810,000. We then need to estimate the growth rate. Therefore, how do you estimate the growth rates? You will recall when I was explaining cost of equity, when we started on our first lecture day, I mentioned that there are two methods of calculating growth rates. Method number one, historical pattern of dividend payment. Method two, Gordon growth model. And I said that the historical patterns of dividend payment is used when past information about dividend payment are given. When you are given the history of dividend payment, that means you are supposed to use the historical pattern or averaging method. When you look at this question, the history of dividend paid between 2021 and 2020, sorry, 2020 or 2011. Let me see. Yes, between 2011 and 2015. Yeah, so you are given information about dividend paid between 2011 and then 2015. So what that means is that we are going to use the historical pattern of dividend payment to calculate our growth rate. So in this case, using the historical pattern of dividend payment, I also gave you different formulas. I said that when you are given, the first formula is n minus 1 into square root latest dividend over dividend paid in the first year. And I said that formula will be used when information about dividend payment for all the years are given to you. The second one is n into square root latest dividend over dividend paid in the first year, all minus 1. And I said that the second formula is used when information about the first year dividend and the current year dividend are given. So in this question, you are given information about dividend payment across all the relevant years. So in this case, we are going to use the first formula, which is G equal to n minus 1 into square root latest dividend over dividend paid in the first year, or minus 1, that you multiply with 100%. So G will then be equal to, between 2011 and 2015, we have 5 years. So here will be 5 minus 1. Latest LD is latest dividend or current year dividend, which is 810,000 over dividend paid in the first year, BD. Dividend paid in the first year is 320,000, or minus 1. So we can say G is equal to, mathematically, you don't need to waste time on this. We have done it before. This is 810,000 over 620,000. If you know how to use a second function in your calculator, no need to be doing one by one. Just use your calculator, get the final answer, and move on. Nobody will mark this one for you. You just have to show your workings. But the way you do your working, nobody will mark it for you. So 5 minus 1 is equal to 4. Therefore, you are going to raise what you have inside the bracket. You raise it with the power of what you have outside the bracket. 5 minus 1 is equal to 4. I would then say 810,000 over 620,000 raised to power 1 over 4, or minus 1. Okay? Then you use your calculator to get the final answer. So what do I have on the calculator? Starting from the power, 1 divided by 4 will give us 0.25. Therefore, 810 divided by 620 equal, then raised to power 0.25 equal minus 1 equal multiplied by 100% equal to 6.91%. So the growth rate is approximately 7%. The growth rate is approximately 7%. So this is how to calculate growth rate. One more workings we need to do. In the calculation, in the information given to us, we are given share price of 3 naira 27 kobo per share cum div. So which means that the current dividend of 810,000 naira has not been paid. Therefore, we need to calculate ex-div share price. So working number 3, ex-dividend share price. Ex-dividend share price. So, and we said that ex-dividend share price is cum div share price minus the current dividend. Okay? Cum div share price of 3 naira 27 kobo minus the current dividend. Current dividend is 27 kobo, we calculated. So the difference is 3 naira. Ex-div share price is 3 naira. So with this information, we can then proceed to our calculation of cost of equity. So KE equal to current dividend is 27 kobo, we calculated, multiplied by 1 plus the growth rate of 7%. That will give us 1.07 divided by ex-div share price of 3 naira plus the growth rate of 7%. All of this multiplied by 100%. So cost of equity is equal to, bring out your calculator, 0.27 multiplied by 1.07 equal divided by 3 equal plus 0.07 equal, then multiply by 100%. 16.63. Here is 16.63%. Approximately, this is 17%. So cost of equity of Equity PLC is approximately 17%. Let me check the messages. Please, what page? Okay, somebody has already answered you. All right then, confirm. Thank you, Akko. All right, so step 2. Step 2 is to calculate cost of redeemable debenture. When I was reading the question, I commented on it. It is redeemable debenture because you are told in the question that the debenture will be redeemed at par in 10 years' time. Since we are given the redemption date, so we are going to treat it as cost of redeemable. So I would then say calculating costs of redeemable debenture, KD. So we said cost of redeemable debts is estimated as internal rate of return. And to do this, you are supposed to carry out two steps. Step one, you assume two discount rates that will produce a positive and negative NPV. Step two, you calculate cost of redeemable debt using internal rate of return formula. That's all you need to do. Anytime you are asked to calculate redeemable debt, that's just go ahead and calculate internal rate of return. So we need to assume two discount rates. We are starting with 10%. So first column will be for year, description of item, cash flow, discount factor at starting with 10%. Then we're going to have column for present value. Year zero. In year zero, you have the current market value of the debenture. So according to the question, let's go and identify the market value of the debenture. We are told that the current market value is 77 naira 10%. Annual interest has just been paid. So because the debenture interest has been paid, it means that the 77 naira 10 kobo is already X inch price. No need to make any adjustment because the debenture interest has been paid. Then, of course, we are told that this debenture will be redeemed in 10 years' time at par. So that means the company will pay annual fixed interest from year 1 up to year 10. So year 1 to 10, fixed interest. So we then go back to the question, what's the coupon rate of this debenture? We are given 7% debenture. So coupon rate, the interest rate is 7%. Again, we are not going to use 7 if you are given tax rate in the question. So in this question, you are given a tax rate. You are given a tax rate of 30%. So you must adjust for tax. So that will take us to working number 4. We need to go and calculate post-tax interest. You see the way we are moving. For any variable that you need to do your calculation, if you don't have it, you need to go and make adjustments. All right. This is post-tax or after-tax interest. So this is computed as interest multiplied by 1 minus tax rates. Interest is 7% of 100 naira, which is 7 naira, multiplied by 1 minus 30% tax rates. So this will give us 4.9, that is 7 multiplied by 0.7, that's 4.9, 4 naira 9 kobo, that's it. So that's our after-tax interest. So I will then come here, instead of 7, I will use 4.9. You must know the variable that you should be looking out for in a question. What's wrong with you? 4.9. Okay, so finally in year 10, in the final year, this debenture will be redeemed. How are we going to redeem it? Examiner told us to be redeemed at par. So if it's at par, that means at 100 naira. Remember, debt is always quoted at 100 naira per unit. Okay. Let me complete my table. Okay. Divide this one into 2. This one 2. So this will be our NPV. Okay, now we want to calculate present value. Discount factor for year 0 at 10% is 1. 1 multiplied by 77 will give us 77.10. So we need to calculate annuity factor of year 1 to 10 at 10%. So in this case, this will be equal to 1.10 raised to power 10 minus equal, that's 0.836 minus 1 equal divided by 0.1 equal to 6.145. Annuity factor of year 1 to 10 at 5%, sorry, at 10% is 6.145. Then discount factor for year 10 at 10% is 0.386. So we then multiply to get the present value. 4.9 multiplied by 6.145 equal 30.11. Then 100 multiplied by 0.386 will give us 38.6. Of course, this one is in brackets. So to now get the NPV, you are supposed to add together the positive present value, which is 38.6 plus 30.11, then minus 77.1. That's 8.39, negative 8.39. So we assume 10% we have a negative NPV of 8.39. We need to assume a lower discount rate that will produce a positive NPV. Therefore, let's assume 5%. Somebody should go ahead and give me an annuity factor of year 1 to 10 at 5%. What do you have? Yes. 1.05 raised to power
7.7222.
Okay, 7.722. Thank you. You are correct. This is 0.614. Discount factor for year 10 at 5% is 0.614. Okay, then we multiply to get the present value. So here is 77.10. So here will be 61.4. That is 100 multiplied by 0.614. Then 4.9. Where's my calculator? 4.9 multiplied by 7.722 equal, that's 37.84. 37.84. We then get the NPV at 5%, which is 61.4 plus 37.84 equal minus 77.1 equal 22.14 positive. So we also assume discount rate of 5%. We got a positive NPV of 22.14. Now that we have two opposing NPV, so we can then proceed to calculate the cost of redeemable debenture. So KD, cost of redeemable debenture, that is internal rate of return, is computed as lower discount rate plus NPV of the lower discount rates over net present value of the lower discount rate plus present value of the higher discount rate. All of this multiplied by higher discount rate minus lower discount rate. Okay? So cost of redeemable debenture would then be equal to 5% is lower than 10. So 5 plus NPV of the 5, 22.14 divided by 22.14 plus NPV of the higher, 8.39. All of this multiplied by higher discount rate of 10 minus lower discount rate of 5. Final answer, what do you have here? So start from the denominator. 22.14 plus 8.39 equal, that's 30.53. So 22.14 divided by 30.53 equal, multiply by difference between 10 and 5, which is 5, equal, plus 5 equal to 8.63. This is 8.63%. So approximately the cost of redeemable debenture is approximately 9%. Okay? So that's that. Then step 3 is to calculate WACC. Calculating weighted average cost of capital, denoted as KW. Because we don't have preference share in the question, therefore, our WACC will be computed as equity value over equity plus debt multiplied by cost of equity plus debt value over equity plus debt multiplied by after tax cost of debt. So this is the formula that we are going to use to calculate our WACC. So with this formula, remember what I told you, at all time, you have to use market value to form the proportion of equity and debt in the company's in the company capital structure. You don't use the book value except the examiner asks you to do it. If you are not told to use the book value, then you can't use the book value. You have to use market value at all time. Therefore, in this case, we need to go and calculate the market value of equity and debt based on the information available. So working number 5, we want to calculate market value. So equity value. In the question, we are given number of shares. Therefore, equity value will be equal to number of ordinary shares multiplied by XDIV share price. So equity value is equal to 3 million shares multiplied by XDIV share price. We calculated 3 naira. I think that should be working about 3, yes, 3 naira. So market value of equity will then be equal to 9 million naira. We do the same thing. We calculate market value of the debenture, which is computed as nominal value multiplied by X interest price over 100 naira. Remember, debt is always quoted as 100 naira per unit, except if examiner wants you to use other figure. So I will then go back to the question, what's the nominal value of the debenture? We are told that the debenture, 7% debenture is 1.3 million naira. So here will be 1,300,000. multiplied by X inch price. The market price of the debenture, we are given 77 naira 10 kobo over 100 naira. So the market value of the debenture will then be equal to 0.771 multiplied by 1,300,000 equal 1,02,300. So we then determine the total market value of equity and debt, which is equal to 9 million plus 1,02,300. So total market value will then be 10,02,300 naira. Okay, that's total market value of equity and debt. So let's move on. So WACC is equal to equity value is 9 million naira. Market value of equity and debt is 10 million 2,000. Let me write that. 10,02,300 multiplied by cost of equity of 17%. We calculated 17% plus the debt value is 1,02,300 naira divided by total value of 10,02,300 multiplied by after tax cost of debt. We calculated 9%. So there is no need for you to adjust for tax. You've already adjusted for tax. We've adjusted for tax before you arrive at the 9%. Remember, we calculated post-tax interest. Working number 4. You've already adjusted for tax here, so you don't need to adjust for tax again in your formula of WACC. Okay, but if you have never adjusted for for tax, before you get your cost of redeemable debenture, then when you get to the formula, you adjust for tax, 1 minus tax. But because we have already adjusted for tax, that's why we are not adjusting again. So from the left, 9 million over 10 million 2,300 equal, then multiply by 17. That's 15.30. Here is 15.30% plus from the right, that's 10%. That's 10%. 10% of 9%. That will give us 90. There is 0.90%. So when you add the two together, our WACC is 16.20%. So the WACC of Equity PLC is approximately 16%. This is how to estimate weighted average cost of capital. This is how to estimate weighted average cost of capital. Let me know if you have any question for me. If not, we switch to the question and then have another illustration. Any question? Is there anything doing you why? In this question we just solved so that I can provide clarification. Who is speaking? I've told you if you want to talk, always raise your hand. Go ahead, Usman.
Hello, sir. Yes, I just wanted to ask. My question is simple. I wanted to ask whether this qualifies for an exam type question. You know, you've always been saying the ones we ask.
This is a past question.
Yes, I said, does this qualify for an exam type question?
This is an exam question.
Okay. That's my question, sir.
Yeah. Yeah.
Yeah.
Yes.
Sorry, Tutor.
Moses.
Yes, where you calculated the growth rate. I think the other
Yeah.
time we calculated, we used when they gave us historical method. If the dividend is given to you historically, that's why we use that n minus one. But from this question now,
Yes.
the dividend given to us historically.
Take your question again.
Based on computation of growth, if you want to calculate of
Yes.
growth, we say if dividend is being given to you historically, you use
Yes.
n minus one, then square root of the first dividend and the last one, then minus
Yes.
one. But from this question now, I said that I think the dividend is not given to us historically now, but you are using formula of
You said dividend is
historically.
not given to you historically.
Yes. Or
How how do you mean by that? You can
yeah,
see in
you
the
check the question
question.
very well. Huh?
Hello, Moses.
Huh?
You can see from the question you are given the history of dividend payments, the amount of dividend paid in 2011, 2012, 2013,
Oh,
2014, 2015. You are given the amount of dividend paid across all the relevant years. That's history now,
all
isn't
right,
it?
all right, sir.
So that's what we mean by historical pattern, because the past information about dividend payments are given to you. When you have that, that means you are supposed to use averaging method or historical pattern of dividend payments.
All right, sir. Thank
So
you, sir.
you are welcome. Yes, Mr. Atlisa, talk to me.
Sorry, sir. I just want to get clarification. Like how you told us that unless if tax is being given before you consider tax in calculating cost of the
Yes,
venture, then in calculating works, I think if tax is not given, also you will not consider tax.
if tax is not given to you, you don't need to, you are not going to consider tax now. Just ignore it.
Okay,
You
thank you,
only
sir.
consider tax if you are given information about tax. Like in this case now, we are given tax rate of 30%. That means anytime you are given tax rate, you must adjust for tax on your interest, because your
Yes.
interest must be after tax or post-tax interest. But if you are not given
Thank you,
tax
sir.
rate, you just ignore it. Yeah. Any other questions so that we can have two more illustrations to go? Okay. So I shared a question on your WhatsApp. I need one of you. I need all of you to go and pick it. Let me stop sharing this. Let me open to Golden Book and pick it from there to read. Okay. Um, let me see. Let me open it from somewhere. Um, stop. Let's see. Yes, Jeffrey, talk to me.
Hello, sir. Please, how did you get the dividend used to calculate cost of equity?
How did you get the dividend?
Yes, sir.
We did the working. I think you are the one that was asking question the other time. I think you came late. In our
Yes, sir.
workings, I think was working number one. We calculated dividend per share, because in the question you are given total dividend. The current dividend is 810,000 naira. So we then convert it to dividend per share, which is 810,000 naira divided by number of ordinary share of 3 million. So that's what gave us the 27 kobo.
Okay, sir. Thank you, sir.
Jeffrey. All right. So later in the day after our class, I'm going to share the working notes so you'll be able to see it from there.
Thank you, sir.
Right. Yes, this is the question I shared with you on your WhatsApp. Like I said, go there and pick it. Let's solve the question together. This question involves some technicality that I need to demonstrate to you how to do it, so that in case you have similar situation, you will know how to navigate it. Yes, who is helping us to read? I'm not sure we have any ladies. The ladies are not in class today. I've not been hearing. I'm not. Dorcas, are you sure you are here?
Yes, I'm
Elizabeth,
here.
Ethan, good evening. Who again among the ladies? Oluwabukola, Oluwatosin, Ruth. Almost all of you. There are so many ladies in the class, but I've never heard your voice today. So I need one of you to read for us. Dorcas, you want to try?
Okay, sir. Good evening, sir.
Good evening.
Okay. Courage PLC is a manufacturer of collapsible furniture located in Abakaliki. The company is trying to decide on the cost of capital to use for the evaluation of a prospective investment project. The company has an issued share capital of 500,000 ordinary shares of 1 naira each, currently quoted at 1 naira 17 kobo per share, cum div. It has also issued 200,000 naira of 10% debenture, which are redeemable at par in 2 years' time, with a current market value of 105 naira 3 kobo, 1,000 naira of 6%, currently quoted at 40 kobo per share. The preference dividend and the ordinary dividend, including the debenture interest, are due to be paid soon. The ordinary share dividend will be 60,000 naira this year, and the directors have publicized their view that earnings and dividend will increase into the indefinite future. The company's current earnings are 500,000 naira, while the capital employed is 5 million naira. The fixed assets and working capital of the company are take it up.
Dorcas, I can't hear you again. Take it
Yeah,
from the
let
companies.
me take it up. Okay,
Okay.
the company's current earnings are 500,000, while the capital employed is 5 million naira. The fixed asset and working capital of the company are financed as follows: ordinary share of 1 naira each,
Leave that
500,000,
one.
6%
Leave those
preference
ones.
share. All right. The company tax rate is 40%, payable 1 year in arrears. Required, advise the management of Courage PLC on the appropriate cost of capital to be used for its investment.
Thank you
Sir.
very much, Dorcas. See, you have to be very careful. You have to be very careful before you put your pen to paper and begin to solve questions. You have to be very careful. Question may appear simple and straightforward, but any question you see that is short, you have to be very, you have to shine your eye. Examiner has hidden something, and you have to shine your eyes to be sure that you are doing the right thing. Now, when you look at this question, in the capital structure, we have ordinary share capital of 500,000 naira. We have preference share capital of 100,000 naira. We also have a debenture of 200,000 naira. So which means that to calculate WACC, you are going to carry out 4 steps. Now, the first step is to calculate cost of equity. In the question, you are told that ordinary dividend, preference dividend, and the debenture interest are due to be paid soon, which means that you are going to calculate ex-div share price. Okay, you are going to calculate ex-div share price of the ordinary shares. You are going to calculate ex-div share price of the preference shares. You're also going to calculate ex-int price of the debenture. Not only that, in this question, examiner did not tell you that you are not asked to calculate growth rate, but it's implied in the question because examiner has told you that the ordinary share dividend will be 60,000 naira this year, and the directors have publicized their view that earnings and dividend will increase into indefinite future. The current earnings are 500,000 naira, while capital employed is 5 million naira. So you are given information about earnings and capital employed. That means there is growth in dividend payment. Remember, I told you that there are two methods of calculating growth rates. The first one is historical pattern of dividend payment. The second one is Gordon growth model. The Gordon growth model is used to calculate it's used to calculate growth rates when information about earnings and capital employed are given. So in this question, you are given earnings and capital employed. So that technically means that you are going to calculate growth rates. So not only that, the main reason why I have to choose this question, ordinarily I would have ignored it, is because of this tax. That's what I said, you must shine your eye. In all the questions we have solved so far, in most of the examples that we did in class, tax as paid in the current, in fact, examiner was silent. We are not told whether tax will be paid in the current year or in arrears. So, and that's why we have been calculating it in the current year. Now, in this particular question, examiner is telling you that tax is payable 1 year in arrears. So what that simply means is that if tax is payable 1 year in arrears, that means there is 1 year lag. So the profit of the first year will be taxed in the second year. Profits of the second year will be taxed in the third year. So there will be 1 year lag. So if there is 1 year lag, that means the annuity factor you are going to calculate will start from year 2. Like in this case now, for the debenture, we are told that the debenture will be redeemed in 2 years, will be redeemed at par in 2 years' time. So that means ordinarily you are supposed to calculate annuity factor of year 1 to 2 when you are calculating your cost of redeemable debenture, internal rate of return. But because tax is payable 1 year in arrears, you are not going to start from year 1. You will start from year 2. So you are going to do annuity factor of year 2 to 3. Then you now calculate discount factor of year 1. You less it from the annuity factor of year 2 to 3. Whatever your annuity factor, you calculate annuity factor of year 1 to 3, then you now calculate discount factor of year 1. So you now deduct it. Whatever you have thereafter will represent annuity factor of year 2 to 3. So that's what you need to do. So quickly, let's solve this question. And then I need you to open to the question at your end so that I can switch. Courage PLC. Let me go. Courage. PLC. So the first thing you are going to do, examiner is asking us to calculate cost of capital. So of course, we have identified that we are going to calculate traditional WACC because you are given information about capital structure. And in this question, there is ordinary share capital, preference share capital, and also debenture. That means we are going to carry out 4 steps. So step 1, we calculate cost of equity. So how do we estimate the cost of equity? Of course, we are going to use dividend valuation model because you are given information about dividend and share price. So KE equal. And also in the question, we are given information about profit after tax and then capital employed. So which means there is growth in dividend payments. So in this case, it will be current dividend multiplied by 1 plus the growth rate over XD share price plus the growth rate multiplied by 100%. Okay. So we need to go and calculate current dividend per share, growth rates, and then XD share price. So this will be first page, second page, third page. Let's go to the fourth page for our workings. working number 1. We want to calculate dividend per share. Let's move faster so that we can complete work today. So here will be total dividend. We are not given dividend per share. We are given total dividend. So total dividend divided by number of ordinary shares. Akko, talk to me.
Sir, a very quick one. This working we are doing, how do we
Yes.
link it to our answer? How do we refer our examiner to our answer? I know in SBR, you can say working 1 in your main answer. So here, how do we refer to our working, sir?
It's
Thank
the
you.
same thing now. If you want to do that, it's the same thing. Just the same way we are doing it, just link it to your calculation. That's all. Just attach it to your workings. It's the same thing.
Oh, okay,
But
please.
that one,
It helps us to be reflecting it so that we can see how you are doing it.
that one is more is better. It's better to link it if you are you are preparing a table, for example. So it's easier to link it. But in our own case, it will look so hard. I will show
Okay.
you later on. Just hold on.
All right, sir.
So according to the question, number of ordinary shares is 500,000. So here will be 500,000 shares. So 60 divided by 500. 60 over 500. That's 12 kobo. Dividend per share is 12 kobo. So working number 2. We have also identified in the question that there is growth rates because we are given information about earnings or profit after tax and then capital employed. That means there's growth. So we need to calculate growth rates. And we said, now, to calculate the growth rates, we are going to use Gordon growth model because we are given earnings and capital employed. So using Gordon growth model, we said that growth rate is computed as return on capital employed multiplied by the retention rate. R is the return on investment, B is the retention rate. So for this purpose, you need to calculate return on investment or return on capital employed, which is earnings divided by capital employed. Multiplied by 100 over 1. So in this case, according to the question, how much is earnings? We are given earnings of 500,000 naira. Capital employed is 5 million naira. So here is 500,000 divided by 5 million. Multiplied by 100 over 1. So return on capital employed is 10%. Then we also calculate the retention rate. Retention rate is calculated as total earnings minus total dividend over total earnings. Multiplied by 100%. So we are given earnings of 500,000 naira minus total dividend of 60,000 naira over total earnings of 500 multiplied by 100%. So this will give us 440 divided by 500 multiplied by 100%. That's 88%. So that means 12% is paid out as dividends and 88% is retained in the business for growth and expansion. So now that we have computed return on investment and then retention rates, we can then calculate the growth rate, which is R multiplied by B as shown above. This is equal to 10% multiplied by 88%. So our growth rate is 8.8%. You can say approximately 9%. Growth rate is approximately 9%. Also in the question, working number 3, also in the question, the share price given to us. The share price, let me go back to the question. The share price given to us is, where is that? 1 naira 17 kobo per share, cum div. So because the current dividend has not been paid, therefore we need to convert the cum div share price of 1 naira 17 kobo to ex div share price. So let's calculate ex div. Ex div share price equal to cum div share price minus current dividend. Which is equal to 1 naira 17 kobo minus dividend per share. We calculated 12 kobo. Minus 0.12. Therefore, ex-div share price will be 1 naira 5 kobo. So with this, we can then proceed to calculate our cost of equity. Growth rate is 9%. Dividend per share is 12 kobo. Ex-div share price is 1 naira 5 kobo. So let's go up there. Who was the last person that was asking question the other time? Is it Usman? No. Anyways.
I was the one.
Akko, yeah. Okay.
Yes, sir.
So you can see, look at what I'm trying to say the other time. Now, current dividend is 12 kobo. We calculated current dividend per share to be 12 kobo, 0.12. So in this case now, if you want to follow that route, the one you were saying the other time that how do we indicate the workings that we have done in our solution? Of course, like I said, it will make your work look very ugly. That is only appropriate if you are using a table. Let's say, for example, you want to prepare profit or loss account, or you want to, so like in our own case now, if I come here, we have calculated dividend per share to be 12 kobo. You can just say, okay, working, you will see it will look very ugly. This is working number 1. So you then say multiply by 1 plus the growth rate. You know, growth rate is working number 2. Was it working number 3? Let me confirm. I think growth rate is working number 3. Yes. No, working number 2 is growth rate. Working number 3 is ex-div share price. So I will come here. My growth rates, 1 plus growth rates, which is I would then say 1.07. My growth rate is 7%. I will say working number 2. You can see the way it will look. It will be very ugly. That's why we don't usually put workings in this kind of. When you are using a formula, there's no point for you to be putting your workings. But what is important is that you just have to show your workings. All right, you can show your working. But if you are using a table, right, of course, by the time we get to capital budgeting, where we are going to be using table, you will see me using those workings. In fact, I usually create a separate column for workings. But in this kind of formula, it's not appropriate at all. It will make your work look very, very, very tattered. So I would not advise you to do that. So Here is 1.07. Is it 7 or 9%? Let me confirm. The growth rates, I think it's 9%.
It is 9, sir.
Yes, it's 9%. Thank you. So 1.09 over XD share price, we calculated 1.05. That's working number 3. Then plus the growth rates of 9%, 0.09. All of this multiplied by 100%. So our cost of equity would then be equal to 0.12 multiplied by 1.09 equal divided by 1.05 equal then plus 0.09 equal multiplied by 100%. That's 21.46%, approximately 21%. So this is approximately 21%. Cost of equity of Courage PSC is approximately 21%. Step 2, because in the capital structure, we have preference share also. That means we are going to calculate cost of preference share. Then before you put it down, you need to ask yourself what kind of preference share. Is it redeemable or irredeemable preference share? Examiner did not tell you whether it is redeemable or irredeemable. However, in the question, you are not given the redemption date for the preference share. Therefore, you are going to calculate as cost of irredeemable preference share. Okay? So, and then we said this is calculating cost of irredeemable. And we said cost of irredeemable preference share is calculated as the ratio of fixed dividend to XD share price. KP, cost of irredeemable preference share, is computed as the ratio of fixed dividend to XD share price multiplied by 100%. Okay. So we need to go and calculate fixed dividend. What's the fixed dividend? According to the question, remember what I told you. I said that the fixed preference dividend is calculated as nominal value multiplied by the nominal rate. Nominal value multiplied by the nominal rate. Working number 4. Fixed dividend. Fixed preference dividend. Per share. So in this case, dividend per share will be calculated as the fixed dividend, which is, like I said, is the nominal rate, nominal value multiplied by nominal rate. So in this case, nominal value we are told is 1 naira. What's the dividend that the preference shareholders will receive? We are told 6% preference share of 1 naira. So that 1 naira is the nominal value. 6% is the dividend that the preference shareholder will earn in the business. So which is 6%. So this will give us 6 kobo. Okay. So then we go back to the question. What's the market price of the preference share? This is 6 kobo. We need XD share price. So we then go back to the question. The market price of the debenture, we are told that the preference share is quoted at 40 kobo per share. And we are told that preference dividend has not been paid. Therefore, we need to adjust for dividend. So let's go to working number 5. You see the way we are making our adjustment. That's what is expected of you. You must know what to do next. So I want to calculate X dividends, X preference dividends, or X dividend preference share. So to do this, it's the same formula. You are going to pick the cum div share price of 40 kobo less the fixed dividend. Fixed dividend is 6 kobo. So XD share price is 34 kobo. So that's it. That's what I took my time to date to be explaining all those little things that you are going to meet when you get to work. So this is 0.34 multiplied by 100%. So what do we have here? 6 divided by 34 equal, then multiply by 100%. 17.65%, approximately 18%. So the cost of irredeemable preference share is approximately 18%. Step 3, calculating cost of redeemable debenture. This is where you have some technicality, because if you don't shine your eye, you may not get it correctly. So we're assuming, as usual, we're assuming 10%. We then use the 10% to estimate NPV. Create a column for year, description of item, cash flow, discount factor, starting from 10%. Then we are going to have present value. Year 0, current market value of the debenture. Let's go back to the question. We need the market price of the debenture. According to the question, you are told that the current market value of 105 naira 30 kobo. Okay, so the market price of the redeemable debenture is 105.3, and we are told that debenture interests are due to be paid. So that means the 105.3 is cum int price. We need to convert it to X int price. And then interest rate on the debenture is 10%, 200,000 naira of 10% debenture. So 10% is the coupon rate, is the interest rate, and the market price is 105.3 cum int. So we need to convert it to X int price. So let's go and calculate X int price. Working number 6. X int price, which is cum interest price of 105.3. Then you less interest. Interest is 10% of 100 naira, which is 10. So X inch price will then be equal to 95.3. Okay. So let's go and indicate that. So here is 95.3. You can see we are given 105.3 as market price of the debenture, but because debenture interest has not been paid, it means that the 105.3 is PUM inch price. So we need to convert it to X inch price, and that's what we have done. So in this question, examiner now told you that this debenture will be redeemed at par in 2 years' time, okay? So we need to pay annual fixed interest. So I will come here fixed interest. How much interest are you paying? Are you given tax rates? Yes, we are given tax rates in the question of 40%. So that means we need to go and calculate. We can't use the interest rate is 10%. We cannot come in and we can't use 10. We have to adjust for tax. Ordinarily, if there is no tax, I will just put 10. But I cannot put 10 because I'm given tax rates. You must adjust for tax. So I will then go and do working. Working number 7. We want to calculate post-tax interest. Which is equal to interest multiplied by 1 minus tax rate. Interest is 10% of 100 naira. Tax rate is 40%. That means we are supposed to account for 60%. So this is 6 naira. Okay, so let's go up there. So here will be 6 instead of 10. Now, okay, I'm coming back to that later. Now you can see this interest ordinarily we are supposed to calculate annuity factor of year 1 to 2 because we are told in the question that the debenture is redeemable at par in 2 years' time. So ordinarily we are supposed to calculate annuity factor of year 1 to 2, and then in the final year, which is year 2, we redeem the debenture, okay? But we cannot calculate year 1 to 2 annuity factor. We are going to do year 2 to 3. Why? Because in the question you are told that tax is payable at 40% 1 year in arrears. Because tax is payable after 1 year. So in that case, you cannot do year 1 to 2. You are going to do year 2 to 3. There must be 1 year lag, okay? So here will be year 2 to 3. Then the redemption value is at par, which is 100 naira. Let me complete my table before we proceed. Okay. MPV. There is 1. So we need to go and calculate annuity factor of year 2 to 3. Pay attention. There is no annuity factor in between years. There is no formula to calculate annuity factor in between years. Therefore, what are you supposed to do? You are going to calculate annuity factor of year 1 to 3. All right, you calculate annuity factor of year 1 to 3. You then calculate discount factor of year 1. You less it from the annuity factor of year 1 to 3. It will give you annuity factor of year 2 to 3. If you don't want to follow that route, you can be doing it one by one. You calculate discount factor of year 2. You calculate discount factor of year 3. You add it up. It will give you the same answer. However, you can't be doing that when you have a longer years. You can't be doing that. Say, for example, you have if the redemption date is in 10 years' time, you can't be doing it one by one. It's a waste of time. So let me show you how to calculate annuity factor in between years. I've already explained it, but let me just demonstrate for you. Working number 8 now. Annuity factor. AF. So the formula remains the same, which is 1 minus 1 plus R raised to power minus N divided by R. So that will give you annuity factor. In our own case, we want to calculate annuity factor of year 1 to 3. So I will say annuity factor at 10%. Okay, so you do for years 1 to 3, years 1 to 3, which is equal to 1 minus 1 plus R. We are assuming 10%, so 1.10 raised to power minus 3, because you are doing year 1 to 3 over 0.10. So this will give us, this should be 2.487. Then you do discount factor of year 1, which is equal to 1.10 raised to power minus 1. This will give us 0.909. When you find the difference, it will give you annuity factor of years 2 to 3. Annuity factor of years 2 to 3. So what do we have here? That should be 1.5 something. 2.487 minus 0.909 equal 1.578. So this is how to calculate annuity factor in between years. Okay? This is how to calculate annuity factor in between years. When we get to capital budgeting, we do more of this. All right. So 1.578 so here is 1.578. Then discount factor of year 2 at 10% is 0.826. So here will be 95.3. So here is 82.6. Then 6 multiplied by 1.578.
9.467.
9.467, let's say 9.5. 9.5. So 82.6 plus 9.5 equal, then minus 95.3 equal minus 3.2.
3.2.
Okay. NPV, we assumed 10% and we had negative NPV of 3.2. Then let's assume a lower discount rate to get a positive NPV. Okay. Again, let's go and calculate annuity factor of year 2 to 3 at 5%. annuity factor at 5%. So in this case, we first of all calculate annuity factors of years 1 to 3, which is equal to 1.1 minus 1.05 raised to power minus 3, okay, over 0.05. What do we have here? This will give us 1.05 raised to power 3 minus equal minus 1 equal divided by 0.05 equal, that's 2.723. 2.723. Then you calculate discount factor of year 1, which is equal to 1.05 raised to power minus 1. Okay, what do we have here? 1.05 raised to power 1 minus. That's 0.952. 0.952. So this will give us annuity factor of years 2 to 3 at 5%. You see, it's not difficult. You just have to know what you are doing. All this knowledge will not come on a platter of gold. You have to burn the midnight candle. You have to practice, 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 practice. Then you become a master. All right. So 952. That's 1.771. Annuity factor of year 2 to 3 is 1.771. So here is 1.771. Then discount factor of year 2 at 5%. This is 1.05 raised to power 2 minus equal 0.907. So here will be 90.7, then 6 multiplied by 1.771 equal 10.63. So let's say 10.6, 1 decimal place. Then here is 95.3. So NPV at 5% would then be equal to 90.7 plus 10.6 equal minus 95.3 equal to 6 naira. So now that we have two opposing NPV, we can then proceed to calculate cost of redeemable debenture. So KD, that is internal rate of return, equal to lower discount rate plus net present value of the lower over net present value of the lower plus net present value of the higher discount rates, all multiplied by higher discount rates minus lower discount rates. So 5% is lower. 5 plus NPV of the 5, 6. over 6 plus NPV of higher, 3.2.
Plus 3.2.
So 10 minus 5. So 6 divided by 9.2 divided by 9.2 equal, then multiply by 5 equal plus 5 equal, that's 8.26. Cost of redeemable debenture is 8.26%. This is approximately 8%. Okay, so we have calculated cost of equity to be equal to 21%. Cost of irredeemable preference share is 18%. And we just calculate cost of redeemable debenture to be 8%. Step 4 is to now calculate weighted average cost of capital. So, since we have the three of them in the capital structure, we are going to use the full formula. So, KW equal to equity value over equity plus preference plus debt multiplied by cost of equity plus value of preference share over equity plus preference plus debt multiplied by cost of preference share plus value of the debenture over equity plus preference plus debt multiplied by after tax cost of debt. If you have already adjusted for tax, ignore the 1 minus t. Don't need for you to put 1 minus t so that you don't confuse yourself. So in this case, based on this formula, we need to go and calculate market value of equity, market value of preference share, and the market value of the debt. So let's do it. Let's do it because we are going to have this. We overestimated the pages. So let me do working number. That should be working number 8 or 9. We stop at working number 8. So let me write working number 9 here. This should be working number 9. We overestimated the pages. All right. So here will be, let me put it. Market value. So we want to calculate market value of equity. Equity value. You can see examiner did not ask you to calculate market value, but it's implied in the question because at all time you have to use market value to form the proportion of equity and debt when you are calculating your work. You can only use book value if examiner asks you to use it. In most cases, the question will be silent and you should know that you are supposed to use market value. So you can see now in this particular question, we are not asked to use market value, but we are using it because that's the right thing to do. Okay, so to then get market value of equity, I will go back to the capital structure in the balance sheet to go and check whether I'm given ordinary shares. Yes, I have ordinary share capital of 500,000. So I can say for equity, market value will be number of ordinary shares multiplied by XDIV share price, which is equal to 500,000 shares multiplied by XDIV share price. We calculated 1 naira 5 kobo. That's working number 3, I think. Yes, working
Yes.
number 3, XDIV share price is 1 naira 5 kobo. So this will give us 525,000 naira Market value of equity is 525,000. We also calculate market value of the preference share. In this case, I will also go to the balance sheet to go and check whether I'm given number of preference share or I'm given share capital. I'm not given number of preference share, I'm given share capital of 100,000 naira. Okay? So in this case, my formula will be share capital multiplied by XD, share price. Share capital divided by nominal value or nominal price. So P equal to 100,000 naira over the nominal price of the preference share is 1 naira. Is it 1 naira? Let me go and confirm. Yes, it's 1 naira. 6% preference share of 1 naira. So the nominal value is 1 naira. So multiply by XDiv share price. We calculated 34 kobo. So this will give us 34,000 naira. Somebody can ask me, where did you get 34 kobo? That's the XD. I think that's working number 6 or thereabout. Yes, working number 4. No, working number 5 rather. This is 34 kobo. X dividend preference share. Okay. So then the third one, which is the market value of the debenture, is calculated as nominal value multiplied by X int price. Last week I demonstrated for you, sorry, X int, I said X. I demonstrated for you how to do all of this, how to calculate market value. X int price over 100 naira per unit. So G would then be equal to, what's the nominal value of the debenture? 200,000 naira. X int price, we calculated X int price to be 95 naira, 30 kobo over 100 naira. You can see SFM is not difficult. Just know what you are doing. Again, practice makes perfect. Just have to continue practicing. That's the best way to know SFM. Just continue to be solving questions. Any question you can lay your hand on, continue to solve. The more you solve, the more you'll be exposed to likely question you are going to meet on that day. This is our exchange price we have calculated before. Therefore, 0.953 multiplied by 200,000. That's 190,600. So I will then calculate total market value of equity plus preference plus debt. So total market value equal to 525,000 plus 34 plus 190,600. This should be equal to 190,600 plus 34 plus 525.
749,600.
749,600. 749,600 naira is total market value. Okay, so now that we have this, we can then proceed with our work. Equity value is 525,000 divided by total, which is 749,600 600 multiplied by cost of equity of 21% plus 34,000 over 749,600 multiplied by cost of preference share 18%. Let me confirm that 18%, is it? Yes, 18%. Then cost of redeemable debenture is 8%. Plus 190,600 over 749,600 multiplied by 8%. Okay, so from the left, our work is equal to 525,000 divided by 749,600 equal multiplied by 21 equal 14.71%. Plus the middle 34,000 divided by 749,600 equal multiplied by 18. That's 0.82 plus 190,600 divided by 749,600 equal multiplied by 8. That's 2.03. We then add it up. So this will then give us 14.71 plus 0.82 plus 2.03 equal to 17.56. So WACC of Courage PSC is 17.52%. This is approximately 18%. Okay, the WACC of Courage PSC is approximately 18%. In the question, you have to advise the management of Courage PSC on the appropriate cost of capital to use for its investment. You have to advise. You then say Courage PLC should use 18% to evaluate its investments. Let me check whether examiner call investment opportunity. To evaluate, to use for its investment. Okay. All right, so that's that. That's the end of the question. You can see all the adjustments. We had about 9 different workings that we calculated because of this question. This is what is expected of you. All right. So, any question for me? We have one more question to go. Yes, Akko, talk to me.
Thank you, sir. My question
You're
is
welcome.
at the calculation of the market value of
Okay.
of the equity, market value of equity. Why
Okay.
didn't we divide the share capital by nominal price the way we did with preference share? Why didn't we
if you if you pay attention in my last class, in the class we had last week, when I was showing you how to calculate market value, I gave you two different formulas. The first formula to calculate market value of equity, I said, is number of ordinary shares multiplied by ex-div share price. Before you put down your formula, you must check from the question first. Do you have number of shares? If you are not given number of shares, certainly you are going to have share capital. So the second formula is share capital over nominal price multiplied by ex-div share price. Now, in this question, you are given number of ordinary shares to be 500,000. That's what I did not use share capital. Do you get? So in the question, I have the number of shares already. So it's only when you don't have number of shares that you are using share capital. In this preference share, we don't have number of shares, but we are given preference share of 100,000 naira with a nominal price of 1 naira. So to get the number of preference share, it will be share capital over nominal price. That will give you number of shares that will then multiply with the ex-div share price.
Okay, sir. Thank you.
You are welcome. So any other question so that we can solve one more? Any question? Okay. So let's have one more illustration on this, and that will be the end of work. So that in our next class, we'll move straight to, we are going to be doing project-specific cost of capital. Let me copy and paste. Let me even see the question we want to subset. I think I indicated it the other time. Let me stop sharing this.
It's 15.
Example 15, right? Okay, let me share. No, not 15. Not 15. Yes, illustration 18. I indicated it. So, what this one saying? Calculate the market value after tax weighted average cost of capital of JP, explaining clearly any assumption you make. Okay. Then discuss why market value weighted average cost of capital is preferred to book value weighted. Okay. Let's see. Let's solve this. I need one of you to help us read, please. Who is helping us quickly?
Let me read, sir.
All right, go ahead, Justin.
Illustration 18. The directors of Gin Daddy PLC, that's JP, an Abuja-based entertainment company, are currently considering the appropriate cost of capital to use in appraising capital investments. It is the policy of the company to assess the financial viability of all capital projects using NPV criterion. You have been provided with some financial information of the company. You have the most recent statement of financial position. All figures are assumed to be correct. JP has an equity beta of 1.2, and the ex-dividend market value of the company's equity is 1 billion naira. The ex-interest market value of the convertible bonds is 168 million naira, and the ex-dividend market value of the preference shares is 50 million naira. The convertible bonds of JP have a conversion ratio of 19 ordinary shares per bond. The conversion date and redemption date are both on the same date in 5 years' time. The current ordinary share price of JP is expected to increase by 4% per year for the foreseeable future. The equity risk premium is 5% per year, and the risk-free rate of return is 4% per year. JP pays profit tax at an annual rate of 30% per year. Required: calculate the market value after tax weighted average cost of capital of JP, explaining clearly any assumptions you make. B, discuss why market value WACC is preferred to book value weighted average cost of capital when making investment decisions. 15 marks in
Thank
total.
you, Tosin. Yeah. So when you look at this question, it may appear very simple, right? And if care is not taken, you may not be able to earn your full mark because there are some adjustments you need to make in your calculation, particularly in the determination of cost of convertible bonds. Okay, you are given a 7% convertible bonds, and you are told in the question that the current ordinary share price of JP is expected to increase by 4% per year for the foreseeable future. So how do you determine the growth rates? How do you determine the growth rate of a share price? All right. How do you do this? If you don't know the right formula to use, certainly you are going to be stopped. And thank God it's not the only question you have there. But you can imagine, as simple as it is, if you don't know, you don't know. There's nothing you can do about it. All right. So without wasting more time, what are you supposed to do in your calculation here? There are 4 steps you are going to carry out to calculate your WACC. The first step is to calculate your cost of equity. Okay? How do you get your cost of equity? In this question, you are not given dividend. Okay? You are not given information about dividend. You are also not given share price. Okay? So in that case, how then do you calculate your cost of equity? Since you are not given dividend valuation model, you are not given dividend and share price for you to be able to, even though you can determine your share price because you are given ex-dividend market value of 1 billion naira. To get the share price, it should be total market value of equity over number of ordinary shares. So that will give me the share price. So number of ordinary shares, examiner has told me that the ordinary share capital is 200 million. Sorry, it's 200 billion. Figures are in million. Okay, so all I need to do is to then divide 1 billion divided by 200 million. So that will give me that should be 5 naira. So the share price is 5 naira. But in this case, we are not using dividend valuation model because you are not given dividend. You are not given dividend. You are not given information to calculate your dividend. Therefore, you have 2 more methods that you can use. You can either use capital asset pricing model or you use Miller and Modigliani. You are going to use capital asset pricing model to estimate your cost of equity. If in the question you are given information about risk-free rate of return and the beta value. You are given beta value of the company, and you're also given the market return and then risk-free rate of return. So in this question, examiner has given you the market information, market statistics. You are given equity risk premium, okay, to be 5%. You are given risk-free rate of return to be 4%. And then, of course, in the question, you are given market return, okay? Because you are given risk premium, so that's 5%. So there's nothing you don't need. Let me see. Where is the market? Okay, I've already seen it. All right. So in this case, so you are going to calculate your cost of equity using the capital asset pricing model. Then step 2, we need to calculate cost of preference share. What kind of preference share is this one? According to the question, we are told that the company has ex-dividend market value, okay, of preference share of 50 million, okay? So, and then in the table, we are given 5% preference share of nominal rate of 1 naira, nominal value of 1 naira, which is 80 million, okay? So, to do this, there are 2 ways you can calculate your cost of irredeemable preference share. It's either you use total value. If you want to use total value, it will be the 5% of 80 million divided by the market price of 50 million. So you multiply with 100%. All right. If you don't want to follow that route, if you want to use par value. So to use par value, then if your nominal rate is 1 naira, that means number of preference share is 80 million shares. So number of preference shares is 80 million shares. So in this case, it would be 80 million shares multiplied by so of course, first of all, since you are using par value, you divide it by number of ordinary shares. So that would be 80 million. What's it called? The nominal value, the share capital is 80 million divided by the nominal rate, nominal value per share, which is 1 naira. So it will give you a number of shares. Then you now multiply by with the XD share price. XD share price, you are told is 50 million. 50 millions on what? So, of course, since you are using par value, so you get your answer, you get your cost of preference share, irredeemable preference share. Then, where you have major work is the cost of convertible bonds. Remember, I told you under convertible securities, investor will only convert if it is profitable. That is, if conversion value is higher than the redemption value, then the investor will exercise his or her rights. But if conversion value is less than the redemption value, the investor will not exercise his rights. So in this case, what are you supposed to do? First thing first, you need to determine, because the examiner has told you that the current ordinary share price of JP is expected to increase by 4% per year for the foreseeable future. So that means you need to first of all determine the share price. How much is the current share price? Current share price, like I told you the other time, we are told is 1 billion naira. 1 billion naira. What's number of ordinary shares? The number of ordinary shares is 200 million. 200 million. So 1 billion divided by 200 million will give you 5 naira. So 5 naira is the current share price. We're now told that at the conversion rate, at the conversion date, at the exercise date, the share price will increase by 4%. Will increase by 4% for the next how many years? Per years for the next 5 years. So we need to use a formula to do that, which is A multiplied by 1 plus the growth rate raised to power n. That's the formula you are going to use to grow your cash flow. All right. So when you do this, it will now give you the price at which you are going to convert, the market price you are going to convert in the next 5 years. So you then multiply with the 19 ordinary shares, because you are told that the ratio of 19 ordinary shares per bond. So the price you are going to get, the share price in the next 5 years, multiplied by 19 ordinary shares. Then you now compare this with the nominal value, with the redemption value. Redemption value certainly will be 100 naira. Anyone that is higher is what you are going to use to compute your NPV. You compute two different NPV, two opposing NPV, one positive and one negative. Then you calculate your internal rate of return. After that, then you move to step 4, which is to calculate WACC. That's what you are going to do in this question. So let me stop sharing this. Yeah. Oh, we have 20-something minutes. So because of time, let me just stop sharing this, and then I will use the golden book to explain this for you so that we can close right on time. Let me use this is the same question. Here it is called Jandola. You've already read the question, so let's just solve. We want to solve it. So, like I said, in the question, we are given information about risk-free rate of return. You are given risk-free rate of return. You are also given the risk premium to be 5 naira, sorry, to be 5%. So in this case, because you are given risk-free rate of return and then market risk premium, so what that simply means is that we are going to calculate our cost of equity using the capital asset pricing model. Because in the question, we don't have information about dividend. We are not given the amount of dividend. So in this case, we are going to use capping, all right? And then to calculate capital, I'm going to explain to you, okay, capping. Of course, you have done this under financial management, so it's expected that you know it. But that notwithstanding,
No. So I did not do financial management too. Sorry
Let
to
me
cut
let me
you.
talk now.
Okay, sorry. I love
Let
to.
me talk now. Capping is a topic on its own in financial management. So let me talk. So when we get to when we get to capital budgeting or business valuation, I'll be doing the explanation on capping. All right, just to brief you, because it's a topic on its own. It's not something we are going to be discussing. It's a period and a half kind of for us to be able to dissect it. And it's not part of your syllabus again. Our examiner has assumed that you know it. So, but in any case, to calculate capping, it is risk-free rate of return plus beta value multiplied by market return minus risk-free rate of return. So according to the question, you are given risk-free rate of return to be 4%. The risk-free rate of return is the rate of return associated with government security. For example, government has you can have government bond, you can have a government treasury bill. So those kind of security ask a risk-free rate of return. Why is it risk-free? Because any investment with government, you can't lose your money as an investor. You can't lose your investment. You can't lose your money with government. Government is not going anywhere, and government is continuum. All right, and that's why it is risk-free. For example, if the government of Buhari owed you some money, now that you have to know, and Buhari has not paid you before he left office, then the current government will be able to pay you your money. If the current government does not pay, the subsequent one will also pay you. So you can't lose your money with government. That's the essence of a risk-free rate of return. And it's usually come from government securities like government bond, or treasury bill. Now, we are given a risk-free rate of return of 4% per year. And that's the 4% you are seeing. This is the 4 you are seeing here. The next one, BE, is the beta value. Okay, BE is the beta value. What's the beta value of this company? Let me see. Director of, where is the beta value? It's my head. Okay, you are told that equity beta, JP has an equity beta of 1.2. JP has an equity beta of 1.2. So that's the 1.2 you are seeing here. Then you are given a risk premium. The difference between market return, let me write it out for you. RF equal to risk-free rate of return. Then BE is beta, equity beta. This is equity beta. RM equal to market return. Then the difference between market return and the risk-free rate of return is called risk premium. Okay, risk premium. So in the question, we are given a risk-free rate of return to be 4%. You are given equity beta to be 1.2. The market return is not given to you in the question, but you are given a risk premium to be 4%. Okay, so is it 4%? Let me see. Yes, risk premium is 5%, not 4. So here is 5%. Then you put it in your formula to get your cost of equity. That's how we arrive at the 10% cost of equity. So instead of using dividend valuation model, because we are not given dividend information in the question, we are only given information about market statistics. You are given risk rate of return and then risk premium, equity equity value, sorry, equity beta. So in this case, you are supposed to use the capital asset pricing model. The capital asset pricing model is a model that shows or that establishes the relationship between systematic business and financial risk. Okay, between expected return and then systematic business risk. So that is capping. Capping is used to calculate cost of equity. It is also used to price risky assets. Risky assets are generally stocks or shares. Shares is considered to be the most risky asset. Okay, and then you can also use capital asset pricing model to estimate expected return. Okay, so these are the three uses of capping. So one of the uses is what we are just doing now, which is to calculate cost of capital. All right, so you can use capital asset pricing model to calculate cost of equity. So to do this, I said this is the formula that you are going to use. All right, so, and then all the variables in the question, we have established it there. That's what I've just put there for you. Put it in the formula, you get answer of 10%. So cost of equity is 10%. Now, I will go back to the question. Now that we have calculated, remember we want to calculate weighted average cost of capital. You want to calculate WACC. And in the question, we have ordinary share capital, we have preference share capital, we also have a debt capital in form of convertible bonds. So that means you are going to carry out 4 steps to calculate your weighted average cost of capital. So out of the 4 steps, we just calculated cost of equity using capital asset pricing model. So the second step is to now calculate cost of irredeemable preference share. How am I going to calculate the cost of irredeemable preference share? You know that irredeemable preference share is calculated as fixed dividend divided by ex-div share price. So I will then go to the question. If I like, I can be using power. If I want to use power value in this question, if I want to use power value, all I need to do is to calculate my fixed dividend. How do I get my fixed dividend? Let me come back here. My fixed dividend is calculated, like I told you in the past, is nominal value multiplied by nominal rate. So in this case, I will go back to the question, how much is the nominal value? 5% preference share of 1 naira. Nominal value is 1 naira. So 5% of 1 naira will give us 5 kobo. So 1 naira multiplied by 5%. So this will give us 5 kobo, 0.05. So that's where we get this 0.05. Then the ex-div share price, ex-dividend share price, ex-div preference share. So how do we calculate this? How do we arrive at 0.625? We want to determine ex-div share price. So I will then go back to the question. How do I get my ex-div share? Examiner has told me that the preference share, we are given ex-dividend market value of preference share to be 50 million. So to now get the ex-div share price, what am I supposed to do? I need to divide the market value of 50 million by the number of shares, by the number of shares, which is 80, which is 80 million. Okay. So in that case, I will say ex-div share price. I just want to demonstrate. I've done the working down here, but I just want to show you the ex-div share price of the preference share will be equal to 50. Is it 50 billion? Let me confirm. That's 50 million. Yeah, 50 million divided by 80 million. The nominal value is 80 million naira. So 50 million divided by 80. So 50 million divided by 80 million. That should give you 0.625. Let me see. 50 divided by 80 equal, that's 0.625. So that's how I got the 0.625 that you have there. This 0.625. When you put it there, you get your 8%. See, you don't need to be, if you don't want to follow this route, there is a shortcut that you can use to get the same thing as cost of your irredeemable preference share. So there's no need to be, see, of course, this is how you are supposed to do it already. Your fixed dividend, your dividend is 5% of 80,000. So here would be alternatively, KP can be equal to, the preference dividend is 5% nominal rate multiplied by nominal value of 80 million naira, then divided by the market price of the preference share. We are told is 50 million naira. So divided by 50 million, or multiplied by 100%. You get the same answer as 8%. Let's confirm it first. So I would then say 5%, 0.05 multiplied by 80 million equal, that's 4, divided by 50 million equal 0.8 multiplied by 100%. That's 8%. So this is another way of solving it. It's the same thing you are going to get. Anyone that is, that is easier for you to do, follow the option, okay? So that's cost of irredeemable preference share. The next one, where you have technicality, is to calculate cost of convertible bonds, okay? In calculating the cost of convertible bonds, examiner has told you that how are you going, this is where you have information about the convertible bonds, okay? This is where you have the information at the exercise date. You are told that the market price of the convertible bond is 168 million naira. You are now told that at the exercise date, the conversion ratio will be 19 ordinary shares per bond. So you then multiply this with the market price at the exercise date. The market price at the exercise date is not given to you. So how do you then determine it? Examiner has told you that the conversion date and redemption date are both on the same date in 5 years' time. The current ordinary share price of JP is expected to increase. What is the current share price? First thing first, you must determine the current share price. How do you get the current share price? Current share price, current market value per share will be equal to, according to this question, we are given the total, the ex-div share price, ex-dividend share price to be 1 billion naira. So to get the share price, so it will be 1 billion naira. Since our figures are in millions, so we are going to do 1,000 here. 1 billion divided by divided by the number of ordinary shares. So in the question, what's the number of ordinary shares? We are given ordinary share capital of 200 million naira at a nominal value of 1 naira. So 200 million naira divided by 1 naira will give us 200 million shares. So here will be 200 million shares. So when you divide your share price, the current market value per share will be equal to 5 naira. Okay, so the share price is 5 naira. So at the exercise, currently the share price of this ordinary share is 5 naira. You are now told that the current ordinary share price of JP is expected to increase by 4% per year for the foreseeable future. So at the exercise date, that is in the next 5 years, in the next 5 years, this current share price of 5 naira will increase by 4%. So to do this, then you need to use a formula to do this to get the revised share price at the exercise date. It will be equal to the cash flow multiplied by 1 plus the growth rate raised to power n Okay, raised to power n. In this case, the cash flow is 5 naira. 5 naira is the current market value multiplied by the growth rate. We are told that it will increase by 4% in the next 5 years. So raised to power 5. So that will give you what you are going to get in the next 5 years. So in this case, I think I have the working here. Let me just show you. It will be 1.04 raised to power 5 equal, then multiply by 5 equal to 6.08. 6 naira 8 kobo will be the share price at the exercise date, that is in the next 5 years. The market price of this the price at which they are going to convert the ordinary shares, to convert the bond to ordinary share, will be 6 naira 8 kobo. So that's what we are going to do, and that's what I've done here. First thing first, let me show you how I did the workings. Let me show you how I did the workings. Yes, this is the conversion value. So to get the conversion value, first thing first, let me just do the normal thing as you normally do it. Now, what do you want to do? We want to calculate cost of convertible bonds. And I told you that investor will only convert if the conversion value is higher than the redemption value. So you want to calculate internal rate of return. Therefore, we are starting from year 0. This is where you have the current market value of the bond. So I will go to the question: what's the market value of the bond? So the bond, we are given 7% convertible bond. So the nominal value is 160 million, but the current market value is 168 million. Remember, to get the market, let me just show you because of time. See how time is flying. Let me just show you how I got this 105 naira. So I've done the working already. Let me just show you so that it will be faster. So this is the X-int price. How do I get it? How did I get the number? The X-int price, we are given X-int price total market value of 168 million. We are going to divide it with the nominal value. So it will multiply by 100 naira per unit. That's how I got the market price, the X-int market price of 105 naira. So, and then that's what you have here. That's what you have here. Then the next cash inflow will be the annual fixed interest, because the company will pay the bondholders annual fixed interest. How do I get the interest? I will go back to the question. Am I given what's the coupon rate of this convertible bond? We are given 7% convertible bonds. So in the question, you're also given tax rates. We are given tax rate of 30% per year. Examiner did not tell us whether tax will be paid in arrears or in the current year. Since you are not told, then we must assume that tax will be paid in the current year. And that's why in our calculation, so we need to go and calculate post-tax interest to get this 4.9. So post-tax interest, let me see if I have it here. Okay, yes, I have the post-tax interest here, which is interest multiplied by 1 minus tax. Tax rate is 30%. That means we are supposed to assume 70, we are supposed to use 70%. 70% of 7 naira will give us 4.9. And this is the 4.9 you are seeing here. That's the 4.9. The next cash inflow will then be for you to compare the higher of conversion value and then the redemption value. Okay, let's go and do working for our conversion value. That's working number 5 in the example here. So let me just read what I wrote here for you. The bonds will be converted to ordinary share in 5 years' time, and the share price is expected to increase by 4% per annum. Therefore, the conversion value in 5 years' time will be calculated as follows. The current share price is 5 naira, which I've demonstrated for you before. That's working number 1 here. This is the current share price. I've also demonstrated that for you in our working somewhere. This is it here also. Okay. Then share price in 5 years' time will be calculated as A multiplied by 1 plus G raised to power N. This is the formula to calculate a cash flow where there's growth. Where there's growth in cash flow, that's the formula to use. Okay, so A is the cash flow, which is the current market price of 5 naira. G is the growth rate, we are given 4%. N is the time period. We are told that in 5 years' time. So when you put it in the formula, we got 6.08. I think I've also calculated this before. That's 6.08. Let me check quickly. 6.08. Yes, this is it here. That's the 6.08 there. Okay. Then, of course, the conversion value, therefore, would then be, you are told that 19 ordinary shares. We are told in the question that the convertible bond of JP has a conversion ratio of 19 ordinary shares per bond. So 19 multiplied by the share price, that's what gives the 116 naira. That's the 116 naira. You then compare this 116 naira, excuse me, you compare the 116 naira with the redemption value. Of course, if the investor is going to redeem the bond in 5 years' time, we are told it to be at par. At par simply means at 100 naira. So 116 naira is higher than 100 naira. Therefore, it is profitable for the investors to convert to ordinary shares. So this simply means that the investors will exercise their rights. So, and that's why in our calculation, you are seeing 116 naira there. So at this point, once you get to this point, every other thing is easier. I mean, it's easy for you. So discount factor for year 0 is 1. 1 multiplied by 105 will give us 105. Then we need to calculate annuity factor of year 1 to 5 at 5%, and we got 4.329. 4.329 multiplied by 4.9 will give us 21. Okay, then in year 5, which is the exercise date, then we have identified that investor will convert to ordinary shares because it is profitable. Ordinary conversion value is higher than the redemption value of 100 naira. So discount factor for year 5 at 5% will give us 0.784. Multiplied by 116, we have 91. 91 plus 21 will give us 111. Sorry, 102. 102 minus 105, we got positive NPV of 7. We then increase our discount rates. Okay, we will increase our discount rates. In this case, I use 7. If you like, you can assume 7. If you like, you can assume 8, 10, but you cannot do more than 10. Okay, so but here I assume 5%. If you do 10%, you are still going to get the final answer, the same thing. All right, but here I assume 7. Therefore, and I use that 7 to get annuity factor for year 1 to 5. At 7%, we got 4.100. You multiply that with 4.9, we got 20. Then discount factor for year 5 at 7% is 0.713. Multiplied by a cash flow of 116, we got 83. Therefore, cash outflow is 105. So 83 plus 20, that's 103. 103 minus 105 will give us -2. Now that we have the two opposing NPV, we can then proceed to calculate the internal rate of return, that is cost of convertible bonds. When you put it in the formula, we got approximately 7%. Now that you have calculated cost of equity, you have calculated cost of equity to be equal to 10%. You have calculated cost of preference share to be equal to 8%. You have calculated cost of convertible bonds to be equal to 7%. Finally, you need to calculate your weighted average cost of capital. This is your formula, all right? But first thing first, you need to go and calculate market value of equity, market value of preference share, market value of the debenture. This is examiner has made life easy for you because the market value of equity in the question. You are given 1 billion naira, okay? Here is 1 billion naira. No need for you to do working again. Ex-dividend market value of the company equity is 1 billion naira. So 1 billion naira, our figures are in millions. So that will be 1 million. That will be 1,000. I'll just come here. Where am I? Okay. So if I want to get total market value now, total market value of equity plus preference plus debt. So the value of equity, market value of equity we are told is 1 billion naira. That's the 1,000 you are seeing there as the numerator. Then we calculated cost of equity to be 10%. So then in the question also, the market value of the preference share is 50 million. All right, we are given 50 million preference share. This is the 50 million preference share as the market value. Okay, that's what you are seeing there in the numerator. This is the 50 million. All right, cost of preference share, we calculated 8%. Again, for the debenture, convertible debenture, the market value is 168 million as given to us. No need to be sweating over this. This is the 168 million, 168 million. All right. So that's the 168 million you are seeing here. Therefore, I will then say 1,000 plus 50 plus 168. So this will give me 1,218 million. That's the total. That's the total market value. That's why we are seeing here, I'm using the denominator 1,218, 1,218, 1,218. Our cost of convertible bond, we calculated 7%. When you put it in the formula, the weighted average cost of capital of Jandola or Janladi or Jandadi, whatever the name, is approximately 10%. That's it. That's it. But if you don't know the right question to ask the question, certainly if you don't know the right direction to follow, you can't get it. As cheap as this question is, if you don't know the right adjustment to make, you can't get it correctly. And you can't know the right question to ask. You won't be able to understand how to probe a question if you have not practiced as many questions as possible. Because this knowledge we are talking about will not come on a platter of gold. You have to burn the midnight candle. You have to practice, just continue to practice until you become the master. That's only when you can be, you have freedom. You have freedom to flare, to express yourself on the day of your exams. But if you don't know the basic things to do, certainly you will struggle. You will struggle. 15 marks, bonus 15. In fact, this should be one of the first questions you are going to attempt on the day of your exam, so that 15 marks, you are sure of it. So finally, in this question, in the B part, you are to discuss why market value weighted average cost of capital is preferred to book value weighted average cost of capital when making investing decision. You recall when I was explaining last week, I was explaining to you market value and then the book value and the reason why you should be using market value. I told you then that market value is preferred over the book value. Investors preferred market value over the book value because the market value reflects the current.
I guess the network, I will Zoom sign them out. I will log them
Sorry.
out.
Yes, the network locked me. I don't know. Let me quickly round up. Sorry about that. Okay, I think I was sharing this. So I was explaining the B part of the question. So I just want to show you how you are supposed to answer the B parts. So examiner is asking you, why is market value preferred over the book value in the calculation of WACC? That's what the examiner is asking you. And I was saying that you recall last week when I was explaining weighted average cost of capital using book value and then market value. And I said that market value is preferred investors preferred market value over the book value because the market value reflects the current market condition and it is the most realistic and acceptable value to investors. The book value just is represents the figures in the balance sheet, which does not incorporate the current market condition. So, and this is what the examiner is simply asking you. So how did I answer this? The market value is the current price determined by the market forces of demand and supply, while the book value represents the historical price as shown in the statement of financial position, that is balance sheet. In the calculation of weighted average cost of capital, both market value and book value can be used to form the proportion of equity and debt in the company's capital structure. However, in the determination of WACC, the market value approach is usually preferred over the book value because the market value reflects all relevant information required to make informed investing decisions by the market participants. Okay? The book value approach is historical and does not reflect new information about the market condition. For this purpose, the use of book value for estimating WACC can result in suboptimality, okay, in decision making. Practically, market value is usually higher than the book value. As a result, the WACC computed using the market value will be higher relative to if book value is used. For instance, the current WACC of Jandola PLC is approximately 10%. You know, we calculated the WACC to be equal to 10%. Okay, let me see. This is the WACC we calculated, which is 10%. So, relative to the book value, if you now want to use the book value, whereas if the book value is used, it will be 9%. See calculation below. I've also demonstrated the book value method. Thus, the use of market value in determining the proportion of each source of finance in a company's total pool of capital is essentially because of the significance of the cost of capital. Is essentially significant to cost of equity in the WACC calculation relative to cost of debt. Generally, irrespective of the method used for weighting, the contribution of the cost of debt to the WACC will not be materially different. Okay, so I now demonstrated how to use the book value to calculate WACC. So to use the book value, remember, you are supposed to add ordinary share capital and reserve to form the proportion of equity. In the question, you are given ordinary share capital, okay? You are given ordinary share capital to be 200 million. Then reserves of 120 million. When you add the two together, equity value will then be equal to 320. The value of the preference share is 80 million. The value of the convertible bonds, book value is 160 million. So we have 320, 160, then 80. By the time you add it up, you get the total value. Okay, let me go back there quickly so that we can round the class up. Okay, so equity value is 320, convertible bond is 160, preference share is 80. When you add it up, that's 560. Therefore, 320, which is equity value over total value of 560, multiplied by cost of equity of 10, we got 5.71. The value of the preference share is 80 million over total value of 560, multiplied by 8% cost of preference share, we got 1.14. The value of the debenture of the convertible bonds is 160 million over total value of 560, multiplied by 7. Okay, we got 2. We got 2. After tax cost of debt is 7%, so got 2%. When you add it up, that's 8.85, approximately 9%. So that's the 9% I was referring to here. So at all time, market value, the cost WACC using market value will always be higher than the WACC using the book value. So this is what the examiner wants you to explain in the question. This is what examiner wants you to. For you to be able to earn your full mark, you need to elaborate your explanation. Yes, David, talk to me.
Sorry, you said market value will always be higher
Than book value.
Yeah, isn't that if there's like capital appreciation in terms of the market price? What is the market price?
When you are calculating your work, the work you are going to get, the value of your work will be higher than the value of your work if you are using the market value will be higher than the value of your work if you are using the book value. That's what we are saying. So in this, our calculation, we calculated work of 10% using the market value. All the calculation we did here, this is the 10%. We are using market value. Here we use market value. So I now demonstrated using book value, which of course we got 9%. So at any time that you use market value to calculate work, the rate you are going to get will always be higher than the rate using the book value, because the market value reflects the current market information. It represents the current market information, but the book value is showing historical value. That's the reason why market value will be higher than the book value. Hope you are clear, David.
But
Okay.
the historical value can still be higher than the market value. That's what I'm saying. Because if the
Historical
price,
value will be higher than market value. What do you mean by that?
it's possible now, like if this price now,
I'm
the
telling
historical price,
you the reality. You are changing it to something else, David. How is historical value higher than when you buy something last year? You bought something of 1,000 naira last year. Is it the same price now today? How could historical value be higher than the current market value?
we're talking about share price now. If the
Yes.
historical 1 naira, it's possible that it can drop to like 50 or 70 kobo. So if
See,
you now use that to calculate, I feel it will also affect the work.
the historical value cannot be higher than, that's what I'm saying. The historical value cannot be higher than market value, because market value reflects the current information, the current market information. There are so many variables that will be involved when you're considering the market value, but the book value is historical. So there's no how your book value will be higher than market value when you are calculating work. That's the implication. And I've also practicalized it. I've shown you now practically, and you can see it. This is 10%. This is 10% is market value. 9% is the book value. It's not the same. Use another question. You still see the same thing. Market value will always be higher. Okay. So I've spent additional 18 minutes of your time. Thank you for borrowing me that. So let me know if you have any question for me. Some of you have disappeared. No worry, it's understandable. Let me know if you have any question for me so that we can close the class. Any question? Any question for me? So in our next class, by the grace of God, we are going to be having project-specific work. I will advise you to go and study, go and read project-specific cost of capital. That's what we're going to do next. Okay, yes, somebody was talking.
No, sir, just to appreciate your effort for the class today, sir.
Okay.
Thank you.
You're welcome. Yes, any further question, I want to release you. You have done well tonight. Okay? All right. So in the absence of no further question, I want to say thank you to all of you, particularly for the fact that you waited behind, even though the past, we have spent additional 90 minutes. Thank you, everyone. I really appreciate. I will see you next time by the grace of God. Good night and bye-bye.